The internet loves to sell a very specific fantasy, waking up to a pile of cash you earned while you were sleeping. But that effortless, day zero wealth is a myth. Passive income never starts out passive. It requires a catalyst. Every single stream of income you will ever build demands a heavy upfront tax. You have to pay it in one of two currencies, a concentration of your cash or a concentration of your labor. That is the dilemma hidden behind those flashy tutorials. Beneath every sleep and earn success story is a reality of setup costs, ongoing maintenance, and high failure rates. So today, we are stripping away the hype. We are going to break down 6 popular income streams and look at the exact setup costs, the actual risks, and what the real profit potential is for each one. This chart plots our evaluation framework. The horizontal axis is upfront effort to start. The vertical is profit potential. We're mapping what each stream demands so you know the price of entry. Pick the engine that matches the resources you have right now. Let's start with the first group, the capital engines. This begins with dividend index funds. By opening a brokerage app and buying an S&P 500 ETF, you are purchasing fractional shares of 500 proven companies, often using just your spare change. The long-term outcome here is automation. Many of these companies share profits every 3 months. When you automatically reinvest those dividends, they buy more shares, which then pay larger dividends, creating a compounding cycle that runs for decades. The trade-off is time. ETFs offer very little short-term profit. You are planting a seed, and it requires patience to see any meaningful harvest. The second capital engine is the United States Treasury I-bond. I-bonds provide a yield designed to beat inflation. Once you buy them online, the interest compounds automatically twice a year, with 0 daily management required. But that safety comes with a rigid condition. You must lock your cash away for at least 12 months. You take a total loss on short-term liquidity. This matrix compares the risks and setup costs for both. You can enter the ETF market for as little as $10, but you absorb market volatility. I-bonds protect your cash, but carry the opportunity cost of tying up your money for a year. Ultimately, capital engines are long-term plays. You sacrifice immediate spending power today in exchange for hands-off financial compounding tomorrow. Our second category is asset leverage, specifically house hacking. This involves taking space you already pay for, like a spare bedroom, an empty basement, or even a parking spot, and listing it on a platform like Airbnb. The immediate profit potential here can be high. A consistent stream of weekend guests or roommates can effectively offset your primary living expenses, often covering your rent or mortgage. But the trade-off is intense. You give up your personal privacy, and you take on the continuous labor of hospitality. You are cleaning sheets, managing keypad locks, and responding to guests. As you can see on this invoice breakdown, the setup costs are moderate to high. Furnishing a space and paying cleaning fees add up quickly. Plus, you carry the risk of property damage or sudden shifts in local zoning regulations. House hacking is a way to flip a housing liability into a cash-generating engine. But realistically, it functions much more like a part-time hospitality job than a purely passive asset. That brings us to our third group, sweat equity. This includes print-on-demand designs, digital products like templates and ebooks, and affiliate marketing. These methods require concentrated labor. You will spend dozens of unpaid hours designing graphics, writing step-by-step guides, or filming niche product reviews. The unique payoff for all that work is the creation of scalable digital assets. Once your design or template is uploaded, platforms handle the distribution. Every sale after the first one carries 0 marginal cost, allowing you to reach a global market without holding physical stock. The major trade-off for digital products and print-on-demand is market saturation. To actually generate traffic, you have to run ongoing social media marketing campaigns. Affiliate marketing has its own hurdle. The initial momentum is slow. You have to build audience trust through honest content before you see your first commission payout. The advantage here is accessibility. The financial setup costs for sweat equity are low, but there is a psychological risk, burnout. You might invest 50 hours into building these digital assets, only to see 0 sales because your marketing didn't land. You are also entirely dependent on platform algorithms. A sudden update on TikTok, YouTube, or Amazon can wipe out your traffic and your income stream. Looking at our chart, we can now plot all 6 streams. Notice how print-on-demand, digital products, and affiliate marketing sit high on the upfront effort axis, while ETFs and bonds sit near the bottom. Sweat equity makes passive income accessible to anyone with an internet connection, but you have to survive a phase of unpaid labor before the income actually becomes passive. Now that we've mapped the effort and profit, we can rank these 6 streams on their long-term stability and true passivity over a 10-year span. This table ranks dividend ETFs and I-bonds at numbers 1 and 2, requiring no daily management. House hacking holds rank 3. Profit is high but demands time. Sweat equity streams sit at the bottom, as internet trends make digital assets highly volatile. This progression involves taking the immediate cash flow from active sweat equity streams and directing it into capital engines, which converts high-effort gains into hands-off stability. So, which one do you choose today? If you are a time-poor optimizer, meaning you have a salary but very little free time, avoid digital products for now. Your path is automating your cash directly into ETFs and bonds. If you are a capital-poor hustler, someone lacking savings, you can leverage your free evenings. Build sweat equity to generate that initial cash. To overcome decision paralysis, we've outlined a Bigu's first 48 hours checklist to force action. Step 1 on this checklist is to conduct an audit of your current resources. You must explicitly weigh your available time against your available money. Steps 2 and 3. Pick exactly one stream and set a micro-target for this week. Draft 1 single spare room listing, sketch 3 shirt ideas, or just buy $10 of an S&P 500 ETF. By taking these small steps today, you start building the underlying systems that eventually take over the heavy lifting of earning a living.